When it comes to the major U.S. stock indices, the S&P 500 index is the most frequently recognized as a gauge of the stock market's success as a whole and a sign of how well-performing large firms are. So come along as we discuss some essential facts regarding the S&P 500 index that every investor should be aware of, including how it operates, how to invest in it, and why doing so would be wise. To begin with, let's first talk about what exactly is S&P 500 index. The joint venture S&P Dow Jones Indices' registered trademark is the S&P 500, sometimes referred to as the Standard & Poor's 500. The 500 largest U.S. corporations make up this stock index, which is generally regarded as the most accurate gauge of the state of the market for American equities as a whole. From a different perspective, the S&P 500 index serves as a statistical gauge of the performance of the 500 most extensive stocks in the United States. Additionally, the S&P 500 serves as a common standard against which the performance of a portfolio can be measured in this situation. Then again, market capitalization, share price, and quite a lot of outstanding shares are also weighted in the S&P 500 index. So, this implies that the degree of influence a firm has over the performance of the index depends on its valuation. But note this, it isn't just the 1/500 of the index, which is represented by each listed company. Consequently, the S&P 500 index is more affected by large corporations, like Apple and Amazon, than by comparatively smaller firms like Macy's and Harley-Davidson. However, one crucial issue is that, even though there are 500 significant enterprises, the valuations differ widely. The market capitalizations of several of the index's biggest companies exceed $1 trillion. The lowest S&P 500 companies, with market capitalization between $6 billion and $7 billion, are more than 200 times smaller than this. Basically, throughout the trading day, the S&P 500 index's value swings continuously, depending on performance-weighted market data for the underlying companies. Let's now discuss the business weighing formula and calculation. The formula for S&P 500 stock weighting is a rather simple one. The market capitalization of any company is first calculated by multiplying the number of outstanding shares by the stock price at the time. Thus, the market capitalizations of every S&P 500 component are then combined. The weight of each firm in the index is then calculated by dividing its market capitalization by the sum. Hence, a business with a market value of $1 trillion, for instance, would account for 2.5% of the index's weight if the total market capitalization of all S&P 500 companies was $40 trillion. But then, which companies would we see affiliated with the S&P 500 index? Well, the 505 stocks included in the S&P 500 index were distributed by 500 separate companies. Because certain S&P 500 component businesses issue more than one class of stock, there is a discrepancy in the numbers. For instance, the S&P 500 index includes both Alphabet Class C and Alphabet Class A shares. Listing every S&P 500 company here isn't practical. However, because the S&P 500 is based on market capitalization, the performance of the largest businesses' stocks dominates the index's performance. In light of this, let's also see which are the top 10 S&P 500 index businesses as of January 2022. This list's order may change over time though, and it most likely will. So, the list is inclusive of Apple, Amazon, Microsoft, Alphabet, Tesla, Nvidia, Meta Platforms, Berkshire Hathaway, Class B, Tesla, Morgan Chase, as well as UnitedHealth Group. With that being said, we are sure the question that arises here is also the one that is frequently asked by a lot of people, and that is, what is so special about the S&P 500 index that one must be entailed of using it? Well, first off, why not? But of course, you might be curious as to why the S&P 500 is regarded as such a valuable market and economic indicator. To answer that, the S&P 500 contains the companies that individual investors hold the most, because it is made up of a wide variety of equities without too many small or obscure businesses. Therefore, approximately 80% of the total value of the American stock market is made up of the 500 largest corporations, and that is a huge number for maintaining credibility. So, now that you might be convinced a little, let's talk about how you can invest in the S&P index. Honestly, it's not that difficult. Shares of a mutual fund or exchange-traded fund (ETF) that passively tracks the S&P 500 index can be used to invest in the index. This means that all of the equities in the S&P 500 index are proportionally owned by these investment vehicles. So, two appealing choices here are the Vanguard 500 Index Fund Admiral Shares Mutual Fund and the Vanguard S&P 500 ETF, which trades like a stock. Both offer incredibly minimal fees and over time produce results that are nearly comparable to the S&P 500 index. Additionally, S&P 500 futures are available to purchase and are traded on the Chicago Mercantile Exchange. These then essentially allow hedging or speculation on the index's future value and are available as buy or sell options. Not that difficult and also offers great value. But, of course, when investing, it is quite common for investors to think if they are making the right choice. And, being honest, it shouldn't be any other way. So, is investing in S&P 500 index the right choice for you? Well, how about we lay out all the details and you decide for yourself. Thus, Warren Buffett, a legendary stock market investor, is credited as saying that the best investment the majority of people can make is a low-cost S&P 500 index fund. It's simple to understand why. The S&P 500 has produced annualized total returns of 9% to 10% over extended periods, and you may easily participate in a passive S&P 500 fund for practically no cost. It is undoubtedly possible to outperform the S&P 500 in terms of investment returns over the long run, if you have the necessary time, expertise, and motivation to thoroughly analyze equities and manage a portfolio. But not everyone has that kind of time or discipline, and novice investors, in particular, would do better by purchasing shares of an S&P 500 index fund until they gain more experience. Therefore, by investing in the S&P 500, you can have a broad perspective on how profitable U.S. companies are, without being overly exposed to the results of any particular company. The S&P 500 can also yield substantial gains for your portfolio over the long term, with little work on your side. But let's not forget a few other reasons as well that make the S&P 500 index a good investment for you. Although all assets are susceptible to short-term volatility, S&P 500 ETFs are more likely to recover from slumps. In addition, an S&P 500 ETF mimics the performance of the S&P 500 index by tracking the index's constituent equities. The index has historically come out on top after every crash, bear market, and the recession it has experienced. So, the S&P 500 is quite likely to rebound, no matter what occurs with the market during the upcoming months. Again, this does not rule out brief downturns in the S&P 500. However, it is nearly a given that this kind of investment will eventually prosper. Moving on, in the long run, S&P 500 ETFs make excellent investments because the index itself has generally generated positive average returns over time, despite experiencing numerous downturns over the years. In other words, even if it will experience both good and poor years, these highs and lows will eventually average out. S&P 500 ETFs are also expected to have positive average returns because they follow the index itself. For instance, the SPDR S&P 500 ETF Trust has generated an average annual return of 9.92% since its establishment in 1993, which is in line with the index's approximate average return of roughly 10% annually. And of course, one of the most important reasons why we would back the S&P 500 index is because many investors may find it wise to invest in individual businesses, but this method necessitates extensive research to make sure you're picking the proper firms. You never have to worry about researching individual stocks or knowing when to purchase or sell with an S&P 500 ETF. All you need to do is continuously make investments, and the fund will take care of the hard work. That's all for today. We would be glad to know your thoughts on what we went over today and why you think S&P 500 could be the right choice for you in the comments below. Don't forget to like and subscribe. Until next time.